Indian markets are caught in a perfect storm. This analogy comes from a movie called Perfect Storm, in which George Clooney played a lead role. It talked about a fishing expedition which went haywire and where their boat was caught in a perfect storm. Why do I compare Indian markets with that movie? If we see over last 1 year, various factors have come together to create perfect storm for India. One, the oil prices climbed up from $55 a barrel last year to about $76 a barrel. Every $1 of oil price going up takes away about $800 million from India's pocket. The rising oil prices widened current account deficit. It instigated rupee depreciation, and it also pushed RBI to be cautious on inflation. As oil prices rose, current account deficit widened, the rupee's overvaluation got corrected. Between 2013 to 2017, rupee was appreciating, but the rising oil prices pushed rupee to depreciate from 63 all the way up to 73 as we speak. As rupee started depreciating, RBI had to raise interest rates, and over last 1 year, interest rates went up by almost a percentage point. Along with raising interest rates, RBI intervened to support rupee by selling dollar, and in the process took away banking liquidity. Banking liquidity, which was 100,000 crore plus last year, became 1,50,000 crore negative on 15th of September due to advance tax outflows, and thereafter it remained relatively tight with negative liquidity. The rising interest rates and negative liquidity created its own pressure on short-term interest rates, which started climbing up. It also restricted refinancing of many companies, including non-banking financial services company, and that resulted into a credit default where IL&FS migrated from AAA to D in a very short period of time. Global media described IL&FS as India's mini Lehman crisis, and that really put pressure on the confidence of foreign institutional investors in Indian market. They started withdrawing money from Indian equity and debt market, and year to date they have taken out almost 100,000 crore combined from the debt and equity market. India also suffered for one very unknown reason. Over last 4 years, we have outperformed our peers in equity market by a significant margin. While Indian equity markets went up in dollar terms despite rupee's depreciation, many other emerging markets from China to Indonesia to Turkey underperformed miserably. This relative outperformance of India pushed foreign investors to take profit out, and that ultimately resulted into stock market correcting. The large cap index Sensex, it's down about 12% in rupee terms, but more than 20% in dollar terms. The small cap index is down 43% from its 52-week high in rupee terms, but more than 52% in dollar terms. If we look at top 1,000 companies, more than half of the market is corrected by more than 30% from its 52-week high. Clearly there is carnage in small and mid-cap stocks, and this has created the perfect storm for India, where neither Indian debt market, nor Indian equity market, nor Indian currency market has given worthwhile return to investors. Where do we go from here? Well, the good news is that majority of bad news is already factored into the prices. And the operative word here is majority of the bad news. Let's first look at the currency. We were overvalued in 2017, and we needed a catalyst for rupee to correct. Rising oil prices provided that catalyst, and rupee is now trading near its fair value. Of course, it can move by percentage here or there, but we don't expect it to swing by another 10% from current level. The interest rates, after rising throughout whole of 2017 and 2018 major part, have now started stabilizing. The 10-year yield has actually declined from 8.25% to 7.9%. So effectively, interest rates have also started stabilizing and started coming down a little bit. The liquidity is gradually improving. Reserve Bank of India is conducting open market operations. In October, they conducted 36,000 crore worth of OMO. In November, they have announced 40,000 crore of OMO. With the conduct of open market operations, the liquidity situation should improve. However, the market does have a concern whether the rising currency in circulation due to festival season and the FX intervention which may continue, will that keep liquidity positive surplus, or will that keep liquidity negative? But expectation is that RBI will manage liquidity to smoothen the nerves of the financial market. The IL&FS credit event has been circled. The management which was responsible for bringing institution to this level has been superseded. New professionals have been appointed to run the company, and we think IL&FS is not India's Lehman crisis. During the crisis time, Lehman Brothers debt was trading at 15 to 20 cents a dollar, whereas IL&FS debt today, depending upon what kind of security you have, is trading between 50 to 75%. Clearly, credit markets believe IL&FS is not India's Lehman. We believe IL&FS issue can be resolved through equity infusion, either by existing shareholders or by new shareholders, orderly liquidation of assets built by IL&FS, recovery of dues from the government, and there might be a little bit haircut to the creditors and lenders depending upon what kind of security they have. With liquidity improving, currency reaching fair value, interest rates reversing, and credit event of IL&FS circled, we believe majority of bad news is already into the prices. However, there are two factors which will continue to influence Indian equity market. One, what happens to oil? Right now, oil has retraced from above $80 to below $80, but the trajectory of oil will continue to impact market. If oil goes to $100 a barrel, equity markets will correct from current level, interest rates could rise from current level. However, if oil comes down to $60 a barrel, equity market will jump from current level, and interest rates will continue to fall from current level. Apart from oil, the second big factor which will be watched by market is election result. At current level of valuation, market is pricing in a stable government, a government which will carry forward the work done by current government, or the foundation which is laid through reforms like GST and Insolvency Bank Board. Oil and election will continue to influence Indian market over next couple of months. What should we as an investor do during this challenging time? Well, normally good news and good valuation does not go together. You get good valuation among bad news and you get good prices among good news. It's important to buy when valuations are in your favor, and clearly with all this barrage of bad news, valuations have corrected. On 16 Jan 2018, Sensex was trading at 10% premium to its 10-year historical price to book average, and small cap index was trading at 33% premium to its 10-year historical price to book average. When we calculated this number on 9th of October 2018, Sensex was at 4% discount to its 10-year historical price to book average, and small cap index was at 10% discount to its 10-year historical price to book average. Clearly, equity valuations have become from premium to discount, and hence in the bad news you are getting good valuation. If you are risk averse investor, you can consider balance advantage fund category. If you are average risk taker, you could consider multi-cap fund category. And if you are willing to take risk, if you are willing to withstand volatility, then do consider small cap and mid cap equity funds. Most importantly, please don't put money at one go. This is not the time to do lump sum investment. Please try to invest via systematic transfer plan over next 6 to 12 months, because oil and election could continue to give volatility to Indian markets. These are tough times, but which is where we believe majority of bad news is priced into the valuation, and valuations have become from premium to discount, and which is why one should start considering investment in various categories like balance advantage fund or multi-cap fund or small and mid-cap funds.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.